Hello, today we are with Robert Prather, who is the president of Dallas-based Vision Research, and we're going to discuss their upcoming IPOs with Robert. And of course, I think the obvious starting point is Uber. It is the talk of Wall Street. It's the talk of City of London. So to get things going, Robert, what are your thoughts on the upcoming Uber IPO?
Sure. I think there's a couple things to talk about when it comes to Uber. In one, it's a company that's seeing monthly active platform consumers growing, revenues growing, trips growing. I think the take rate increased last year. But on the other side of it, you're also seeing adjusted net revenue growth accelerating, increasing competition, like with Lyft gaining market share. Amazon just launched a freight brokerage business, lots of competitors in food delivery and other ride sharing ventures. And it is an unprofitable business. They've had to exit China, Russia, Southeast Asia, and possibly their food delivery business in India. And then in their filings, they talk about that they expect the take rates to fall, and that could continue into the foreseeable future. I guess when we think about it compared to Lyft, which is obviously been another hot topic among IPO investors, it has a lot more scale. Like gross bookings are 6 times higher, revenues 5 times higher, adjusted EBITDA margins are like 2,700 basis points higher. And the valuation appears to be more compelling at this point. So you're talking about 7 times sales, whereas Lyft's trading at over 8 times sales right now. And then I guess with Uber, maybe the one thing that could be a little different from Lyft is that while to this point ride sharing has been the majority of the business, over 80% of the business, and where most of the revenue growth has come from, it seems like maybe they're turning to acquisitions, and like they just bought that Dubai-based company for $3 billion, or announced that deal. And then investments. So in these markets where they've been pushed out of, like China and Russia, they're selling their businesses to the local providers, but they're not taking cash. They're taking a stake in those businesses. So they're hoping those investments grow, and that contributes to their bottom line. And then they're also focused a lot on Uber Freight. So they launched that business in the U.S. in 2017. They've just launched it within the past month in Europe. And then they can continue to focus their efforts on Uber Eats and think that could be a growth avenue for them.
Sure. I think it sets us up nicely for my next question, which is, in our engagement with the investor community at and we feel that a number of people are kind of asking a very pertinent question: where is the IPO market heading in 2019? As of course, we're in the second quarter, and we've seen a number of these big ticket IPOs. Uber, of course, being one on the horizon, or have already IPO'd, as in the case of Lyft. So from gazing into your crystal ball, how's the IPO market looking in 2019?
Yeah, I mean, I guess we can't even keep up with the number of companies that are filing, and you've got both kind of medium-sized companies, so like the Beyond Meat IPO that priced, I think yesterday at the top end of the range, to Pinterest and Lyft and Uber and others. And so it seems to be a very hot market. WeWork now filed, and so it seems like any and everybody that can get some sort of offering done is really racing to the table to get that accomplished. We've seen one, IPO that we've spent some time on this year, not be successful. It was called Alight, and it was kind of an HR, kind of consulting business, and that business is like $7 or $8 billion company, but it had a lot of debt, wasn't growing very fast, and and they pulled the deal totally, like the day before it was expected to price, and blamed it on market conditions, which, Levi's had gone 2 days before at above the top end of the range. So I'm not really sure market conditions are what's to blame, but probably more like the quality of the business.
Sure, it sets us up nicely to conclude the discussion. I think one of the key themes here is Uber, including, is that a number of these companies have listed before they were even profitable. And not let's just not put Uber on the spot, but we look at Twitter, Snap, Spotify, SurveyMonkey. The list is endless. Now, if you're an investor and you're examining these companies, including Uber, it weighs on your mind. So, how do you reconcile this lack of profitability as things stand versus future potential, and decide or opt to invest or not in these companies?
Sure, that's a good question. So I think investors maybe hitting with the Lyft IPO have started to ask that question more. So it appears that was one of the most asked questions during Lyft's roadshow, and then within a few days of the listing, it was one of the most shorted stocks out there. I think while most of these companies are unprofitable right now, if someone can see a road to profitability, maybe they're willing to, I guess, pay up for that sort of valuation. So in the case of Uber and Lyft, like I mentioned, I think Lyft's EBITDA margins are minus 40% or something like that. Uber's have been improving and are, I think, into the 20% range, so much better than Lyft. And then if you talk about like a Pinterest, they're definitely showing a lot of momentum towards profitability. At IPO was priced well, and the stocks performed well. And then when you think about Pinterest and kind of their future growth potential, you have 70% of their user base is outside of the United States, and but only 5% of their revenues come from outside of the United States. And so I think people see that as a big revenue opportunity for the company. I think one of the biggest challenges for a lot of these companies is really the rising cost of customer acquisitions. We've also got low barriers to entry. A lot of these businesses lack stickiness as there's very little product differentiation. I don't know about you, but it's Uber or Lyft, I don't really care. They're about the same price, and as long as they can get me to my destination, I don't really care which one I use. And so a lot of it comes down to what sort of discounts, promotions they're offering for their riders, what sort of incentives they're providing to their drivers, and then SurveyMonkey and Spotify, those rely on a freemium sort of model, and the conversion rates from free to paid users is pretty low. And then there's lots of local alternatives as well. Spot just entered India, but there are already at least 4 local music streaming apps. So there's just, like I said, lots of competition, low barriers to entry, high acquisition costs. And so it is difficult to point to the point where these companies do turn that, dial and can start to grow profitably. There was an IPO today, Eventbrite. It didn't happen today, but they reported after the market yesterday, I think. It's another company that's not profitable. Can't really point to a point where it's going to become profitable. They significantly disappointed the street, and the stock's being cut by a third today. So I think you've got to show that sort of progression towards some of these benchmarks that you've put out there to get towards profitability.
Thank you very much for your time, Robert. That was Robert Prater, who's the president of Vision Research. A number of research and analysis reports written by Robert's team are available via the ReachX marketplace. For more details, log on to reachx.co. Thank you.